I'm Elizabeth Warren, Chair of the Congressional Oversight Panel. I'm here to introduce our February Oversight Report, Commercial Real Estate Losses and the Risk to Financial Stability. 2,988 banks are currently classified as having a risky concentration of commercial real estate loans. All of them are small and mid-sized banks, or community banks as we call them, and they're already weakened because of the financial crisis. The panel is deeply concerned that commercial real estate losses could jeopardize their stability and that the damage will contribute to prolonged weakness throughout our economy. Now, commercial real estate loans are exactly what they sound like. The loans taken out by developers to buy, build, and maintain commercial properties. If you live in an apartment, work in an office building, or shop at a mall, then you've probably spent time in a building that owes its existence to a commercial mortgage. Most commercial mortgages are set up differently from conventional home mortgages. In the commercial mortgages, the borrower makes payments of the interest and a little principal, but the loan comes due in 3 to 10 years, and the whole principal must be refinanced again. This means that every few years, the borrower must apply for credit all over again. If the application is turned down, then the property is foreclosed. And in today's market, many applications will be turned down. The reasons are simple. Many loans were made during the real estate boom, when property values were high and banks were willing to lend money on much looser standards. But property values have fallen 40% on average. Many loans that seemed solid back at the peak of the bubble now look like very bad deals. So banks are unwilling to refinance. And when they do refinance, they want a lower loan-to-value ratio. That will trigger a lot of foreclosures. Now, there were plenty of mistakes. During the good times, many investors in their banks assumed that the happy days would continue forever, that shoppers would keep shopping, vacationers would keep vacationing, and the American economy would keep buzzing along. And some loans were flat out reckless when they were made and never should have been financed. But either way, about $1.4 trillion of loans are due for refinancing between now and 2014. To the extent that these loans can't be refinanced, the borrowers will default, and the banks could face severe losses, perhaps as much as $200 to $300 billion. If you aren't a commercial real estate developer, you may think, not my problem. I wish that were so. A big enough wave of commercial mortgage defaults would trigger economic damage that would touch the lives of every American. Empty offices, empty hotels, and empty stores could lead directly to job losses. Banks that suffer losses, or fear they might, could grow even more reluctant to lend, which could make it even harder for you to get a loan. The largest loan losses are projected for 2011 and beyond. But the stress tests conducted on big Wall Street banks last year examined their stability only through 2010. Even more significantly, community banks tend to hold much greater concentrations of commercial real estate than big Wall Street banks, but community banks never underwent any stress tests at all. In total, nearly 3,000 community banks, that's nearly 40% of all the banks in America, have what the regulators call concentrated commercial real estate holdings, which means they have a very high proportion of commercial mortgages on their books and are at particular risk of being overwhelmed. Now, these are the same banks that provide loans to small businesses that create jobs and boost productivity. If hundreds of community banks go under, the effect could be to dump sand in the gears of our economic recovery. There are no easy solutions to these problems. We have to come down off a big bubble. The panel identifies a number of policies that could help us to contain the problem, at least until the market can return to health. But there's no magic bullet here. You can read all of the ideas we've identified, and you can offer your own thoughts by downloading the full report at cop.senate.gov. America's economy is already under tremendous stress, and our banks are still struggling to recover from a financial crisis of historic proportions. There is a real chance that commercial real estate could deal severe blows to this already strained system. Let us be clear. The government cannot and should not rescue every bad loan or keep every bank afloat. But neither can it turn a blind eye to the dangers of unnecessary bank failures and their impact on communities. We need to start now, before the system is on the brink of collapse, to work out a plan.